What this chapter does is it starts looking at how we can use risk and returns for stocks and individual companies to lay the foundation for figuring out what the discount rate should be for the company. Okay. Now, earlier today, I actually got through most of this chapter, and which is probably good. Chapter 12, homework's not due this week. It's going to be, wow, it's actually 2 weeks from now. It's hard to believe, but it's going to be due in a little while. So homework's not doing this, but we're going to keep plugging along with the material. And yeah, so let's see how it goes. So this is going to take us from talking about diversification and how we forecast stock returns, a simple model for forecasting stock returns, and then basically what we do is we use those forecasts to come up to use for the discount rate for projects, because that's kind of where this is going. So a couple objectives here. The first one is to calculate and interpret market risk. And we do this by calculating something called beta. So beta is our measure of a stock's market risk. So we can calculate standard deviation for the stock. We can calculate standard deviation for the market. But when we go to build a model to help us calculate expected stock returns, we're actually going to use an alternative measure of risk for stocks in the market called beta. And then we're going to look at the capital asset pricing model. And this is like, this is the model in finance. It's not really high tech. You'll see it's basically a simple linear regression model where we take lots of data points and we plot a line through those data points, and that line gives us CAPM, and it allows us to calculate the expected return on the stock based on the expected return of the market and beta. And then we're going to look at how we can calculate the discount rate or opportunity cost of capital for a stock using the CAPM model. So those are the three things that we're going to get out of this chapter. So how do we measure market risk? First off, a couple definitions. When we talk about the market portfolio, that is basically a group of all stocks in the economy. But it's kind of hard for us to track every single company in the economy. So what we typically do is use what's called as a market index. And the market index collects usually like some of the biggest companies in the stock market. So for example, if you look up financial news, you'll probably see, first off, they'll talk about the Dow Jones average, Dow Jones Industrial Average. And that's a really old one. I think that's been calculated for, I'm thinking, at least 100 years. It's not used when we do mathematics in finance, that Dow Jones average. Instead, what we do is we use another market index called the S&P 500 index. It's calculated a little bit better. It uses the same portfolio return calculations that we just talked about today. We use weighted average. Dow Jones is so old that they didn't have calculators. And at that time, I think they just take the stock price and they add up the stock price for every stock in the index. And it's not really a good way to model a portfolio, just a stock price. So we want to look at the total value of each company, and the weighting average kind of does that for us. So when we talk about market portfolio, we have to come up with a way to measure the returns on the market portfolio. And what we do is we use a market index, typically the S&P 500 index. And that's what we'll use to represent the market return. The second concept that we're gonna look at some more in detail is the concept of beta. And beta is basically the sensitivity of a stock's return to the overall market return. And this is our second measure of how we measure risk for a stock. Right, our first measure was standard deviation, and our second measure that we're looking at now is called beta. All right, so this slide shows us how we derive beta for a stock. So in and both of these axes are like returns, right? Stock returns. And the vertical one, that's going to be the stock premium. So let's say we're looking at one particular stock on this slide. Call it any stock you want. So that's our stock return minus the risk-free rate. That's what that vertical axis is. And in the horizontal axis, we have the total market return minus the risk-free rate. Okay. And so the next thing we're going to do is what we want to do is we want to see how one particular stock relates to the total stock market. And what we're going to do is we're going to compare the returns every month. So on this chart, we're going to plot the monthly returns of the stock versus the market. And so that's what these data points I just put up show. So for example, let's look at this data point right here that I'm kind of drawing a circle around. In that month, that monthly data point, the stock return minus the risk-free rate was about a little over 10%. In that same month, the market had a return of about, just go down to the horizontal axis here, that looks to be about like 7%, right? And so each data point represents a different month. And you can look up, based on where that data point is plotted, what the stock return was, or the stock premium, versus what the market premium was. And again, when we say premium, it just means the total return minus the risk-free rate. So what was that stock premium versus what was the market premium? And so the next thing you should notice is that, you know, it kind of, there are a lot of dots and they're kind of moving all over the place, but there's a general relationship, right? And it kind of moves from the lower left all the way up to the upper right. Now, if you remember from your statistics class, you guys may have done something called OLS, ordinary least squares regression. And you use that to do a best fit line in your data points. Maybe you did this in chemistry class too, I don't know. But you probably did it in your statistics class. And so that's what we're going to do next here. I'm not going to ask you to run a regression, OLS regression, but this is what the line would look like. And it's not perfect, right? You see a lot of the data points are kind of above the line, below the line, but it's a pretty good fit. And so this return or stock premium of the stock versus the market is basically going to give us beta, because when you do a regression, right, you basically get two things. You get a y-intercept term and you get the slope, right? And it turns out the slope of this line that we just did, we call that beta. So beta is nothing more than the slope of the best fit line between the stock premium returns and the market premium returns. Because, like, you know how at the end of the last chapter, we talked about how different companies kind of behave differently when something happens in the market, when there's a market risk. If we go into a recession, some companies will do really well, right? The last recession we had, I think, you know, Amazon did great, right? And after the recession, at least, All companies kind of came down because of the pandemic. But then when things started getting better, different companies behaved differently, and not all of them came back the same way. And so this beta is basically shows how a company behaves when the market changes. So it is our measure of market risk. And the more variable a stock goes up and down, the more risk. So in this case, the higher the beta, it means the more sensitive the stock is to the market. A higher beta would give it a higher slope. And that higher slope would basically mean the stock price would change more for any given little change in the market return. So beta is our measure of market risk for a stock that's going to go into our CAPM model. Now, one thing here to take into account, and this coming from the end of Chapter 11, we're not looking at unique risk anymore. This is only market risk. And the reason we can do that is that we're assuming investors are diversified. And so the unique part of what's happening to a stock is kind of being ignored at this point. I'm not totally ignored, but we're saying that let's assume that investors are diversified. And so unique risk is really not that important, and we shouldn't take that into account for our CAPM model. Okay. I'm not saying it's not important for investors if we're looking at investing in Amazon or Tesla or AT&T or Verizon. But what I'm saying is from building a model standpoint, this is how the model is built. Because unique risk, we can't really forecast, right? And so it's not part of this model that we're going to talk about. So this is just market risk. One way to think about unique risk on this chart is unique risk is where all the error terms are, right? Because we have these data points like up here, we have a data point here and here, and those are far off the line, right? So maybe something funny was happening with that stock. That's kind of the unique risk part of it. And those are kind of like error terms, right? When you're building a line, a model. And so, so we're not going to worry about those error terms. If the model fits better, that's fine. But the important thing is, what's the overall average relationship between the stock and the market? Because we're focused on market risk. And just to remind us, right, total risk is equal to unique risk and market risk. And unique risk in this case, we're kind of assuming is not there because we're dealing with the market where investors can diversify away unique risk. And so now we're just going to focus on market risk, and that's measured by beta. Now, we can calculate beta for a single stock, but then we can also calculate beta for a portfolio of stocks. And we do that with just a weighted average equation. Very similar to the portfolio return equation, which was a weighted average. Same thing here. You take the percentage of your portfolio value, dollars, or whatever currency you have, and you multiply that by the beta of each stock, and then you add it up, and that's our weighted average. Here's a little interesting factoid. If you owned all the stocks in the stock market, basically the market portfolio, what you would calculate for beta would be 1.0. And the reason is for this, right, is remember beta kind of is kind of that slope for the line that depicts the stock return versus the market return. But if your stock is the market, if you own the market portfolio, then beta really represents how your market portfolio relates to the market portfolio. And so that's like 1 and 1, right? And so A beta of 1.0 is basically the base market risk, which makes it pretty easy to kind of at least conceptually get. Because what that means then is the stocks that we were talking about that do like worse than the market when times are good, or no, we're talking about stocks that do better when we go into recession, right? And we listed stocks like Costco, big supermarket chains, Albertsons, Safeway, Trader Joe's. Oh, I think that's a private company. Those type companies, Target, Walmart. What it means is that they have betas less than 1 because they have lower market risk, right? So stocks that don't get hurt during a recession are going to have betas less than 1 because they're less sensitive. But stocks that are going to get really hurt when the overall economy gets hurt, they're going to get hurt even more, like casinos, travel, entertainment stocks, that type of thing. That means that they're going to have betas higher than 1. Okay? And the other thing we find is that stocks that are growing really fast, they tend to also have betas higher than 1. So someone mentioned Amazon. You'll see now Amazon's kind of strange. I know they're kind of like an everyday need like Walmart and Target, but the fact that they're growing so quickly makes it so that when the economy does well, Amazon does even better well. And so we see them having typically a beta that's higher than 1.0. Here's just a selection of betas for different stocks. And you can see Amazon here, 2.39. Ford, why would Ford have a really high beta? Probably because, like, if you go into recession, maybe people will put off purchasing new cars. And so that's kind of a discretionary good. And when the economy's good, people will buy more new cars. And when the economy's bad, people will buy less new cars. Used cars, it's a little different story, but at least with new cars, that's the way it works. And then if you go down the list, you'll see some of these companies like Heinz, Campbell, I think that should be Campbell Soup, not Campbell Soup, Walmart. They have relatively low betas. They're not growth stocks, but when the economy does poorly, they just keep humming along because people keep going, buying those everyday consumer goods that they have to buy. What this chart shows is that same one we did a couple slides ago where we got beta, but this shows it for a portfolio of growth stocks. And this is the Vanguard Explorer Fund, which is a fund that basically just invests in growth stocks. And so you notice here, beta is greater than 1, right? Because we have a greater than 45% slope, if you will. It's very steep. And so the slope is very high. And that's what we see with growth stocks. And then if you look at, here's the same slide, but this is for S&P 500 index fund. And so this is kind of like a proxy for the market portfolio. S&P 500, it's kind of 500 of the biggest companies in the stock market. It's not always the 500 biggest. Sometimes they want to add in companies that are, growing quickly, but it's considered 500 of the most important stocks in the stock market. So this has a beta of 1. So that's good because, right, this is what we use to kind of represent the total market. So the fact that it has a beta of 1 is really good because that means it's a good return to use to represent how the overall market is doing. So remember last class, we talked about how the total return on a stock equals the risk-free rate plus the risk premium, or the extra return, just compensating us for risk. So what I want to do now is let's change that equation around a little and solve for the risk premium. So what that means is, another way of stating it is the risk premium equals the total return minus the risk-free rate. Because that was what we were using for that chart a couple slides ago on the axis, right? We had the stock market premium and the stock premium and the market premium. So this is where we get that. The premium equals the return minus the risk-free rate. And the market risk premium is just the market return minus the risk-free rate. Here we see a different type of chart. And what it does is it shows the return on the vertical axis and beta. And when we look at beta equal to 1, you'll notice that means that shows us where the market portfolio is. And so this shows what the expected return premium or stock premium is for stocks that have different betas. So as beta goes up, the expected return on a stock goes up as well. That's the key thing on this. That leads us to the capital asset pricing model. Now, typically in finance, we call this the CAPM. So the CAPM is the theory that states there's a relationship between risk and return, where the expected risk premium on any stock equals beta times the market risk premium. And that's basically kind of like that first chart we looked at. That kind of shows it. But now we're gonna also see how it looks mathematically. So here's the risk premium on a stock on the left-hand side of the equal sign. And here's the risk premium of the market on the right-hand side. And then it's just multiplied by B, which is what we use for beta. And so this is the math equation for CAPM. But we do one more thing. We usually rewrite it so the stock return is alone by itself on the left-hand side, and then it looks like this. So the return of the stock equals the risk-free rate plus beta times the market premium. So that right there, that is the CAPM model. And a little foreshadowing, basically what this means is that the CAPM model kind of gives us the expected return for a stock. And this will start to form the basis for the opportunity cost of capital for investors, where they can get better returns on their money. And for a company, it means this is the return that they have to meet in order to invest money. And so this is kind of like the beginnings of our discount rate. It's the expected return on the stock will later feed on into our discount rate. Not too many math equations, not too much Excel today. It's a lot more concepts like this. Here's that same equation, and it has a definition. It's called the security market line, and it's basically the graph that graphs returns versus beta. That is the security market line, and people call this kind of a graphical representation of CAPM. So you look up the beta for a stock, and that basically helps you figure out what the expected return is for that stock. So you take beta for the stock, and it gives you the expected return for a stock. And for a beta of 1, which is the same market risk as the market itself, you get an expected return that'll also equal the market return. And notice one more thing, like when we have a line, right, you get the equation for a line is often like y equals mx plus b, where M is the slope and B is your y-intercept, right? And so the y-intercept on this is basically the risk-free rate right here. Here's our y-intercept term, right? And so when we go back to the CAPM model, right down here, right? This is our line, if you will, and the risk-free rate right here is basically our y-intercept term, and then we have the slope and our other variable. So here is the SML security market line graphical representation of the CAPM model. Here's the CAPM model, return equals RF plus beta times RM minus RF. So if you had a stock with a beta of 0.5, it would lie right here, and you'd have a return that was lower, an expected return that was lower than the expected market return. And so that is CAPM, the capital asset pricing model. I think you've got at least one question on homework 12 for that. Usually the questions on this are fairly simple. It's calculate the expected return on a stock given the risk-free rate, given the stock beta, and given the market premium. So let me just reiterate, this isn't like fancy high-tech finance, but when you look at many more complicated models that predict stock returns, they all still have the market risk premium built in. Because if you look at the market risk premium, the market return RM minus RF and beta, by itself, that usually helps us explain between 25 and 50% of a stock's return. And that may not sound great, but it's the biggest factor there is in explaining stock returns is how the overall market's doing. Okay? The other like 75 to 50% of returns that are more unique to a certain stock, and we have built more complicated models that have 25, 30, 35 other pieces of information in that regression that help predict stock returns. But this is kind of like the foundation that has been laid for models that help predict stock returns. So once we have beta and once we have the CAPM model, now we can go ahead and calculate expected returns for all those same stocks that we looked at before with their betas. And so what you would expect then, right, is that a high beta means high expected returns as well. So if you look at, Amazon, clearly we'd expect high returns. And for something like Walmart or Campbell's Soup, you'd probably expect lower returns, right? And that's kind of what we see. Now, the CAPM's not perfect. Like I said, it predicts kind of between 25 and 50% of the returns we see in the market. The other part of that stuff we don't see is a lot of unique returns, right? So this doesn't always line up with what you see in the world. But again, we're making assumptions that we're all diversified investors, and this is kind of a general average expected return that we then use to make evaluations of investment projects. Okay? So these expected returns eventually feed into the discount rate that we'll use. So here's a little caveat. We're going to use those returns for stocks to come up with discount rates, right? But different companies, different industries, they all have different sensitivity to the overall market. So we do have to be careful. We can use the expected return for a stock and use that as the discount rate for a project. And that's what most companies do. But the textbook wants to make it clear to you that we have to look at project risk we have to be very careful. We can't just automatically use the overall risk of the company and the company stock for estimating the discount rate for a particular project. And the reason is sometimes companies go off and do different things outside of their normal business, right? For example, let's say a company normally does all its business in the United States, and we calculate beta and we get an expected return, and we want to kind of use that to help us get our discount rate. But now let's suppose a company goes off to a different part of the world to build a new project. Is that same discount rate that comes from their stock and business in the United States, can you apply that somewhere else in the world? Probably not, because there are different risks. So project risk can entail different discount rates than what you think you should get from the company's overall stock and stock risk. So I think you have one question on this in the homework. So the right answer is you have to look at the project risk specifically, okay? And not just the overall company risk. Here's an example on calculating CAPM for a stock. And I think I just wrote these in down here. They're not on your slide, but they are in the notes section of the slide. So here's an example. You get beta, let's assume 1.3. Let's assume risk-free rate's 0.04, and the return on the market is 0.14. So usually B stands for beta, capital R with a little f, or sometimes a little r with a little f, stands for risk-free rate. That's the T-bill rate. And then R with a little m usually stands for the return of the market. And so here is the CAPM equation. Basically, it's just a matter of plug and play, right? We plug in the numbers for RF, for beta, and RM and RF, and we get an expected return of the stock of 0.17. So I think you've got one of those on your homework for chapter 12.